Real GDP is higher, but nominal GDP is lower, and that could pose a little problem. Why is that? We explained in an earlier shots here about how lower GDP inflation caused real GDP to move higher. But at the same time, lower GDP inflation means lower nominal GDP growth. Let us again explain this in simple terms using a slightly different example. Let us say that your nominal salary of 100 rupees is nothing but 95 rupees plus 5 rupees inflation. So if inflation falls to 1 rupee, your nominal salary will also be impacted. On the contrary, if inflation rises, let's say, to 10 rupees, your nominal salary will also increase fairly sharply. So when inflation is very low, nominal GDP will move lower, like we just saw last week in India's nominal GDP growth rate of 8.8%, 200 basis points lower from 10.8% nominal GDP growth seen in the March quarter. Now, this now has two direct implications, one on fiscal accounts and two on credit growth. How? Let's now jump to the fiscal accounts. The fiscal accounts presented in the budget every year, they are measured as a percentage of nominal GDP. So when nominal GDP growth contracts, all fiscal metrics will experience pressure. Lower inflation means revenues for the government will see some pressure, and therefore spending budgets will experience pressure as well. Let's say 2% of 100 rupees and 2% of 96 rupees. These two are very different things in absolute numbers. Similarly, 2% of GDP in absolute terms with lower nominal GDP growth could also mean a lower number. Secondly, lower nominal GDP growth could also mean some near-term pressures on credit growth. Remember, credit is also directly linked to inflation, just like nominal GDP growth. Having said all of this, one must also remember that in the next couple of quarters, when inflation starts gradually moving higher, these very effects would also tend to normalize, rather reverse.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.